All right, let's go ahead and get this started. My name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech for a global audience of retail and institutional investors. Today, we're going to talk about a company called Butterfly Network, and the title of the presentation says now 40% off. So we'll start by qualifying that. Butterfly Network went public using a special purpose acquisition company. Now, over the past several years, we've covered 84 disruptive tech SPACs, and a common message across all those has been that they're excessively risky. And of those, we're presently invested in just one, and it's also exceptionally risky. So if you look at that universe, we have a tech stock catalog we put together. It has around 400 tech stocks and a lot of different data points. And in there, we have a field that denotes whether or not a company is a SPAC, so we can very quickly filter on SPACs. Took a look at it today. 87% of those SPACs we covered are trading below the price that institutional investors paid, that $10 a share. So when we talk about Butterfly Network being 40% off, we mean that shares trade around $6 a share, which they do. Actually, that number 87% is actually 89% because a couple of those SPACs trade for like, $10.04 and 5 cents. So SPACs have taken a beating. Of course, we need to consider that the broader market has also been taking a beating as well. Now, the last time we looked at Butterfly Network, here's how we left things. We said that since we already have a decent amount of exposure to medical device companies, we're not overly keen to invest in Butterfly. And also, we didn't like their choice to IPO using a SPAC. Now, the medical device companies we're holding right now, the two primary ones are Medtronic and Stryker, and those are being held as part of our dividend growth investing strategy. So, for example, Medtronic, they've not only paid but increased their dividend for 44 years in a row. That's remarkable. Right now, it's a yield of about 2%. You may say, well, that's low. Well, Medtronic has actually raised their dividend over the past 10 years on average 10% a year. So that grows pretty quickly. So we're already holding these medical device companies now. Neither of those two have portable ultrasounds, at least based on the research that we did, but they still fall into the same sort of industry classification. And then we're also holding Johnson and Johnson, which has not only paid but increased a dividend for 59 years running. And J&J, about 27% of their business is in medical devices. So if you look at all the assets we're managing right now, about 4.7% of our exposure is in medical device companies. So we're not excessively interested in getting more exposure by going long Butterfly Network. But today we're going to talk about the company and what they've been up to since the last time we covered them. Their SPAC is completed. Here is their product. So they have a new flavor of their portable ultrasound. So that's the entire value proposition here, is a portable ultrasound. And they define that market as being about $8 billion, the total addressable market, $8 billion. That's not a whole lot. And also, when you consider that the total addressable market they're targeting, it isn't blue ocean, meaning they need to displace existing equipment with their new handheld. And of course, there's an opportunity to open up new use cases in emerging markets where people don't have expensive ultrasound equipment and all that. But it's about an $8 billion opportunity, and they're not the only ones trying to capture it. Now, they are the cheapest of the solutions we looked at. So you can purchase the hardware device you see. It works with a smartphone, costs about $2,400, and then you need to subscribe to a 1-year membership. And the cheapest you can do that is a couple $100. So what, you're in at about $2,600 for the device. And what we thought we'd start by doing is looking at some of the other devices out there. Now, one way to do that is to look and see what people are searching for in Google. This is always fun to do. So you can say Butterfly IQ. It looks like we misspelt it, and Google is smart enough to know that. Butterfly IQ versus these other solutions. So we can start by going through and looking at these other solutions. The one from Clarius. Clarius is a startup. You notice that on their value proposition, they make it a point to highlight affordable pricing without subscription. So, and I'm making sure that they differentiate themselves from Butterfly. The Clarius costs about $5,000. GE has a solution as well. It's called the V-Scan. Now, GE has actually two flavors. The one that you see on the left, the V-Scan Extend, that requires a hardware device, a proprietary hardware device from GE. And you can see that in the picture there, the GE logo. That's not a smartphone, that's a GE device. So that doesn't have the same appeal as a portable device, a portable ultrasound would that can be connected to a smartphone. If you look on the right hand side, that's the new flavor that GE has released. They released that, I think, in March of last year. And that's wireless as well, kind of slick. And the cost of that is about $4,725. So General Electric is also selling. They on their website had said they sold over 30,000 units. And to put that into perspective, Butterfly has sold from 2019, 2020, and to date. So from all of 2019 to date, they've sold over 50,000 units. And we'll look at that detail a little bit later. But G's most likely talking about their V-Scan Extend and not the Air because it's quite new. Then there's two other names here. Eagle View, this is just shady. So the website, it doesn't have any sort of about us. There's no address, and it just wasn't anything we think anybody would consider in a purchase decision. Then you have Philips and their Lumify solution. So we couldn't find any sort of pricing for the Lumify solution, but we did find this study by the University of British Columbia, which looks at three devices: Philips, Lumify, Butterfly, and Clarius. It gives some pros and cons. It's actually quite good. So I suppose you could just Google that. Maybe we'll stick the link to that in the description of this video. But what they had said in this study was that the Philips solution costs about $10,000, so it's quite spendy. Now, when we take a look at Butterfly, so certainly there's competition, formidable competition in the form of General Electric and Philips and perhaps Clarius. And we look at the units sold, Butterfly's doing pretty good, right? You can see a general trend upwards here. Now, I had noticed in one of their filings we were looking at today, they had talked about a pricing change and how that has sort of slowed down their e-commerce sales, but it's hard to say how much. But they did mention that in their last quarterly filing with the SEC. So they've sold from 2019 inclusive to date over 50,000 units. That's great. And when we look at what sort of revenue they're getting, this is important to note. The company says that by the end of this decade, 50% of their revenues will be recurring. That's great. We love recurring revenues. We love to see hardware devices that are accompanied by recurring revenues. Now, ideally, we'd like to see the Illumina setup where Illumina is something like 80% consumables. It's remarkable. So they're just raking in the cash on high margin consumables. But anyways, this is a device, and then they said that existing users of the device will need to replace it in about 3 to 5 years. So they have that recurring hardware, and then also the software as a service, high margin there, of course, and then they need to keep spending on R&D and keep releasing new devices to keep up with the competition. So overall, the company's doing quite well. But when we look at revenues, this was taken from their SPAC deck. And when we revisit SPACs, we're going to be hypercritical about what companies say they're going to do and what they actually do. And yes, we know the coronavirus ruined everything, but the fact is that they came 20% under what they said in their SPAC deck, and that wasn't very long ago. That was in November of 2020. Their SPAC deck said 78 million, and then they revised, and then they came in and hit that revised number. But we're always going to go back and say, what did you say on your SPAC deck, and what did you do today? And they came 20% under. So be that as it may, if you look at the company as it sits today, right at the 40% discount, we use what's called a simple valuation ratio for tech stocks, and we simply take the market capitalization, divide that by annualized revenues, that's last quarter times 4. In this case, we get market capitalization of 1.2 billion, divide that by $58 million, and we get a ratio of 21. we would consider anything 40 or higher to be too excessive. We won't buy any stock that has a ratio of 40 or higher. 21, what does that mean? Well, how long's a piece of string? You'd need to start comparing that to other companies to, do relative comparisons. Now, what that tells us is it certainly wouldn't be considered cheap. It could still fall more. You shouldn't try to catch a falling knife. And if you were to try to take a position in Butterfly, you want to start dollar cost averaging into the company. Just remember that the broader stock market now is undergoing what appears to be somewhat of a correction. So, all tech stocks that when the tide goes out, all boats lower. So, all tech stocks will continue to fall if that correction continues to happen. So, bear that in mind before you go and move in on Butterfly at a 40% discount. So, I think to conclude, we're not going to invest in the company at any price because we already have our exposure to medical devices. We're content with that. The smaller that Butterfly gets, at least based on their revenues in this past quarter, the closer they approach the $1 billion mark, and we don't invest in anything under $1 billion. We call that the death zone when companies get below that. So they're a very small company. We are trying to lean our portfolio towards larger companies, being the risk averse investors we are. So they're on the small side. The hardware device is kind of a one trick pony. So what happens if something goes wrong with the IQ Plus? Oops. And they have their intentions in the spec deck moving towards wearables and things like that. That's great. They're doing a lot of R&D, but this is a one-trick pony. And of course, they're fighting some stiff competition in the form of General Electric and Philips, two companies that have a lot of resources when it comes to selling their devices. And then the other startup that's out there is Clarius was the name. So we're content with the exposure we're getting, and we think Butterfly is a. We couldn't find anything that would lead us to believe this wasn't a great company. In particular, the founder is a serial entrepreneur. His resume is humbling when you read it, how much this gentleman has accomplished. So there's a lot of good things to say about Butterfly. It's just not for us. So go ahead and subscribe to our YouTube channel. We'll be putting out lots more videos. Thank you very much for taking the time to listen to us today, and we'll look forward to talking to you in the future.